Imagine handing over $8 million for a single bet, where the odds of winning are worse than a coin flip, and you won't find out if you've won or lost until the money is already gone. That's not a casino high roller table. That's Tuesday morning for an American oil and gas company deciding whether to drill a new exploratory well. In the industry, it's called wildcatting, drilling in ground where no one has proven oil actually exists. Historical success rates for these exploratory wells often sit below 15% for a genuine commercial find. A single onshore exploratory well can run into the tens of millions of dollars. Offshore, it can climb past 100 million. And here's the part that should stop you cold. The company has to pay the full cost of drilling before it has any idea whether there's anything down there worth pumping. Picture spending the price of a small office building to buy a lottery ticket you can't even scratch off until after you've already paid for it. Now imagine doing that dozens of times a year as a business model. That's the oil and gas drilling industry. So how does a business built on this much uncertainty consistently turn a profit? And in 2026, as break-even costs collide head-on with falling oil prices, is that business model even still working? Here's the first thing most people get wrong about this industry. Drilling isn't the first expense, it's one of the last. Before a company commits tens of millions of dollars to a well, it spends heavily just trying to reduce the odds of failure. Seismic surveys send sound waves into the earth and record the echoes to build a picture of what's underground, sometimes in simple 2D cross-sections, sometimes in far more expensive 3D imaging that can cost millions on its own. Geologists study rock formations, pressure data, and the history of nearby wells, when any exists. All of this analysis happens before a single dollar goes toward the physical act of drilling, and none of it guarantees anything. This is the part that makes oil and gas fundamentally different from almost every other industry we've covered. A construction company knows roughly what a building will cost before it breaks ground. A shipping line knows exactly how much cargo a vessel can carry. An oil company drilling a wildcat well genuinely does not know what it's going to get for its money. It's making a probabilistic bet on geology, backed by the best data science can offer, but geology doesn't negotiate, and it doesn't care how good your data was. Not every well is the same kind of bet. The industry breaks drilling into rough categories, and understanding them is the key to understanding the entire risk structure of this business. A wildcat well is drilled somewhere no one has confirmed oil or gas exists at all, genuinely unproven territory. This is the highest risk, highest reward category, and it's where success rates are at their worst. Some industry data has shown onshore wildcat success rates falling as low as around 10% in difficult years, though skilled operators in well-studied basins can push that meaningfully higher. An exploratory well sits one step down in risk, drilled in an area where there's at least some geological reason for optimism, even without direct proof. Historical U.S. data has shown exploratory wells succeeding somewhere in the range of 50 to 60% of the time in favorable conditions, though this swings hard with technology and basin quality. A development well is the safest bet of the three, drilled in a field that's already been proven to produce, simply extending known reserves. These wells succeed far more often, commonly in the 65–70% range, because the company already knows oil is down there somewhere. The only question is exactly where and how much. Here's the strategic reality this creates. A company chasing the next Permian Basin or the next Bakken shale field has to drill wildcats, accepting brutal odds, because that's the only way to find an entirely new resource. But a company that already controls acreage in a proven field can drill development wells almost like a factory, with predictable costs and predictable returns. The entire industry is really two different businesses wearing the same hard hat, pure exploration and reliable extraction, and the companies that survive long-term usually need both.
Let's sit with the worst-case outcome for a moment, because it happens constantly in this industry, and it's the single biggest risk that separates oil and gas from almost every other sector. A dry hole is a well that, after all that money and all that drilling, simply doesn't produce oil or gas in commercial quantities. Not produces a little, not produces, but it's marginal, commercially worthless. The rig, the crew, the steel casing, the fuel, the mud, the site preparation, every dollar of it is gone, and there's no product to sell, no revenue stream to recoup any of it. For a large company, a single dry hole costing anywhere from $50 to $200 million is a painful line item, but survivable. It gets absorbed into a portfolio of dozens of other wells, some of which will hit. For a smaller independent operator, one dry hole on a major prospect can be an extinction-level event. This is exactly why the industry has developed an entire culture around risk sharing, farm-outs, joint ventures, and partnerships where multiple companies split the cost of a single well and split whatever it produces. Nobody wants to be the only name on the check if the hole comes up dry. There's a phrase used inside the industry that captures the entire psychology of this business. Most of the time, wildcats fail, but the hope is that if a company drills enough of them, the ones that hit will cover the cost of everything that didn't. It's not a business built on avoiding failure. It's a business built on making sure the successes are big enough to pay for the failures, which sounds like gambling because in a very real mathematical sense, it partly is. Assume for a moment that a well is a success. Oil or gas is actually flowing. The spending doesn't stop there. It just changes shape. The physical act of drilling a well, then completing it so oil or gas can actually flow to the surface, is by far the largest capital expense. For unconventional shale wells in basins like the Permian, all-in costs commonly run from several $1,000,000 for a simpler well up to well over $10 million for longer horizontal wells with extensive hydraulic fracturing. And this cost isn't fixed. It moves with the price of steel, cement, fracking sand, and skilled labor, none of which the operator controls. This is where an outside shock has been hitting the industry hard in 2025 and 2026. Tariffs on imported steel and tubular goods, the pipe that lines a well, have driven up the physical cost of drilling at the exact moment oil prices have been sliding. One industry executive put it bluntly in a late 2025 industry survey. Rising tariff-driven input costs are pushing well cost higher, while policy simultaneously pressures crude prices lower, squeezing operators from both directions at once. Drilling rigs themselves are usually leased, not owned, and rig rates fluctuate with demand across the entire industry, exactly like the charter market for cargo ships. When oil prices are high and everyone wants to drill, rig rates climb. When prices fall, rig rates drop too, but not instantly. There's a lag, and companies can find themselves locked into day rates that no longer make sense for the price environment they're actually drilling into. Modern hydraulic fracturing requires enormous volumes of water, sand, and chemical additives, all of which need to be trucked, stored, and disposed of according to environmental regulation. In remote basins, simply getting equipment and materials to the well site can be a meaningful fraction of total cost, another echo of the trucking and repositioning costs we've seen eat into margins in other industries. Drilling requires highly specialized crews, drilling engineers, geologists, mud loggers, safety personnel, and this labor pool shrinks and grows dramatically with the price cycle. When prices crash, as they did multiple times over the past decade, experienced crews leave the industry for other work. When prices recover and drilling ramps back up, companies aren't just paying more for rigs, they're competing for a smaller pool of experienced people, and that labor cost gets baked directly into the cost of every well.
Every well requires permits, environmental review, and eventually, even for a successful well, a plugging and abandonment cost once it stops producing economically. Companies are increasingly required to set aside capital for this end-of-life cost from the very beginning, another expense sitting quietly on the balance sheet long before a well runs dry. If there's one concept that determines whether an oil company makes money or loses it, it's the break-even price, the minimum oil price needed for a well to be worth drilling at all, once every cost is accounted for. And 2026 has put that number under more pressure than it's seen in years. Average break-even costs for drilling new wells in the U.S. currently sit somewhere between $61 and $70 per barrel. Meanwhile, forecasts for WTI crude oil prices across 2026 have ranged from roughly $49 to $57 per barrel, meaningfully below what it costs to profitably drill a new well in the first place. Sit with that gap for a second. It means that under a meaningful share of 2026 price forecasts, a huge portion of new American drilling simply doesn't make economic sense. Companies aren't just facing thinner margins, some are facing genuinely negative math on new wells. The Dallas Fed's late 2025 survey of oil and gas executives found the industry planning its 2026 budgets around a conservative $59 WTI assumption, while simultaneously expecting the actual price to land somewhere in a wide, nervous range between $50 and $82. That's not a forecast. That's an industry admitting it genuinely doesn't know what it's dealing with. Here's the twist that makes this even stranger. When prices fell earlier, the number of active drilling rigs dropped roughly 15% as companies pulled back, but American oil production barely dipped, around 2%, before climbing right back to record highs above 13.6 million barrels per day. Fewer rigs, but record output. Drilling and fracking technology has become efficient enough that companies can produce more oil with fewer wells and fewer rigs than they could a decade ago. That's the industry's best defense against this margin squeeze, but it's also exactly why the good, easy Tier 1 drilling locations are running out faster than expected. Here's something almost nobody outside the industry realizes. Not all oil-bearing rock is created equal, and the best of it is disappearing fast. The industry ranks shale acreage into tiers based on how cheap and productive it is to drill. Tier 1 acreage, the prime real estate, with the lowest break-even costs, some below $45 a barrel, is the land every company wants. But one energy analytics firm estimates that at current drilling rates, the U.S. has only around 6 years of that prime Tier 1 acreage left. After that, companies are forced into Tier 2 and Tier 3 land, lower productivity, higher costs, more geological uncertainty per well. That same analysis projects the industry's average break-even price could climb from around $70 a barrel today to as high as $95 a barrel by the mid-2030s, not because companies are getting worse at drilling, but because the cheap, easy oil is quite literally running out, forcing operators onto progressively more expensive rock. One industry veteran, a pioneer of American fracking technology, acknowledged at a recent industry conference that U.S. crude production is beginning to plateau, a remarkable admission from someone whose entire career was built on proving the opposite was possible. This is the long-term shadow hanging over every short-term pricing headline. Even if oil prices recover tomorrow, the well that gets drilled with that money is on average going to be a worse well than the one drilled 5 years ago. the clock on cheap American oil isn't a future problem. It's already running.
Given everything we've just walked through, brutal exploration odds, dry holes that erase tens of millions of dollars overnight, and a break-in price that's currently sitting above the market price, how does anyone make money doing this at all? The first strategy is diversification across a large portfolio of wells, rather than betting everything on one. No serious oil company survives on a single well's outcome. They drill dozens, sometimes hundreds, understanding upfront that a meaningful share will disappoint, because the ones that succeed, especially the rare, spectacular discoveries, can generate returns that dwarf the combined cost of every dry hole in the portfolio. It's the exact same math a venture capital fund uses on startups, just applied to rock instead of software. The second strategy is risk sharing through joint ventures and farm-outs, spreading the cost and the potential loss of any single expensive well across multiple companies. This turns a bet that could bankrupt one operator into a manageable line item split 3 or 4 ways. The third strategy is prioritizing development wells over wildcats whenever possible, extracting more value from land that's already proven rather than constantly chasing unproven frontiers. It's a lower risk, lower glamour approach, but it's what keeps the lights on between the rare big discoveries. The fourth strategy, and this is the one defining the industry's response to 2026's price pressure, is relentless efficiency in drilling technology itself. Longer horizontal wells, more precise fracking techniques, and better subsurface data mean companies can extract more oil per well and per dollar spent than they could even 5 years ago. It's the same instinct we saw with the giant container ships built to spread fixed costs across more cargo. In oil and gas, the fixed cost of a rig and a crew gets spread across more barrels of eventual output, and that efficiency gain is currently the only thing standing between many operators and a genuinely unprofitable 2026. Go back to that opening image. $8 million spent before you know if you've won or lost. That's not a metaphor for the oil and gas industry. For a huge share of American drilling activity in 2026, it is the literal current situation. Break-even costs sitting at $61 to $70 a barrel. Price forecasts sitting below that, in the high 40s to high 50s. An industry planning its budgets around numbers it privately admits it isn't confident in. And yet, the wells keep getting drilled because the entire business is built to survive exactly this kind of uncertainty, spreading risk across portfolios, sharing the cost of the biggest bets, squeezing more output from every dollar of drilling technology, and accepting as a simple cost of doing business that a meaningful share of the money spent underground will never come back. Oil and gas drilling doesn't make money by avoiding the coin flip. It makes money by making sure it can survive losing enough of them to eventually win big. If you had to bet on it, do you think 2026 ends with oil prices climbing back above the industry's break-even costs or falling further below them? Drop your prediction in the comments. And if you want to understand what happens on the other end of this business, how oil actually gets from a well in Texas to the gas pump in your city, and where the real margin in that journey hides, that's exactly what the next video in this series is going to break down.